Hi, Mount Research. Willie Dowitch here. Glad you have tuned in. Glad you're listening. Glad you're watching this video. For our monthly video update, I figured instead of doing a whole new deck, I would kind of reprise a presentation I did earlier this week to the Sheboygan Economic Club. That's a town about an hour north of Milwaukee. And so we're going to go through the slides I shared with them. I think it's a good high-level, longer-term recap of where we stand and what I'm looking for, and then we kind of drill down a little bit into what we're seeing in the current environment. So some high-level stuff, some drill downs. Here it is, a reprise of the talk I gave earlier this week to the Sheboygan Economic Club, A Return to Normal, the New Environment with an Old Paradigm. And so we start with this slide. Everything we hear is an opinion, not a fact. Everything we see is a perspective, not the truth. What I like about this especially is that this is attributed to Marcus Aurelius at quotas, but there's actually no evidence that he ever said that. So even that, it's an opinion about whether or not we should attribute that to him. But really what we want to look at and think about is the cartoon on the bottom here. One guy says 4, the other guy says 3. Depending on where you stand, things look different. Depending on where you stand, things look normal, things look extraordinary. An example in our house right now, I've taken a teaching job this fall at Wisconsin Lutheran College. So for the first time since COVID, I'm out of the house every morning on a regular basis. At the same time, my wife has started to work outside of the house as well. Son is in high school, the daughters are off in college. So that leaves us with a pretty empty house. That is a normal thing. That's historically what has happened in our family. Well, since COVID, since we started being home a lot more often, we acquired Mowgli. Mowgli is a COVID puppy. He's actually in the room with me right now. And he is not at all used to this idea of the people leaving during the day. And so now when we get home, Mowgli's like, where have you been? His perspective, his reality was always people are at home during the day. Our reality, our longer term perspective was we were home for a while. Now we're getting back to something that's maybe historically more normal, but that's disrupted Mowgli's existence in a pretty significant way. So the lesson there, if you're a COVID puppy and all of a sudden the people go back to work, that seems extraordinary. If you've been in the market only for the past 10 years and you've gotten used to stocks going up at a double-digit 15% pace per year, then if that doesn't happen, that seems extraordinary. If you start to see bond yields rising over time, that seems extraordinary because you haven't seen it, you haven't experienced it. And so then another lesson on perspective is it depends on what you're looking at. Top line here, that's the QQQ ETF for NASDAQ 100, the largest stocks on the NASDAQ over the past 3 years. This was as of early September. NASDAQ 100 had doubled. IWC, that's a microcap ETF, over that same time period, it hadn't just not doubled, it hadn't gone anywhere. Microcaps were lower over the past 3 years, or lower over the past 3 years on net. And now this week, actually, weekly data is not closed yet. This is Thursday, so we'll wait till the end of the week to really put a nail in this, but we're on pace for the lowest weekly close for the IWC for microcaps since late 2020. So again, perspective matters when you're talking about the market. Another way we can think about this is the value line geometric index. I've talked about this in the past, pointed out the number of, how long it's been going sideways. And in fact, it keeps bumping up and through this 550 level. It's gone through it 66 times. Looks like today it'll be the 67th time that the value line geometric index is going to cross over this level that it's been bouncing back and forth across for 5+ years now. So again, perspective. Have stocks been going up? Some have. A lot of them haven't. And so then what's on the agenda for this talk about where we see things from a long-term perspective and what to focus on in a shorter-term perspective? One, it's a new environment for bond yields. The Fed is not friendly. We'll highlight what we're seeing from a central bank perspective. The Fed didn't move this week, but it made some noise nonetheless. Stock market is trying to get back in gear, can't. Investors, They're all in on stocks and they're paying a premium for that. Look at the economy, the inflation. It's not just something that happened post-COVID. It's not just a reaction to COVID. The seeds were sown prior to that. What's happened since then has been fuel on that inflation fire. From a real growth perspective, less than meets the eye. And then I think the bottom two are the really important parts. What if we're wrong? So what would be the evidence that this longer term secular shift isn't playing out or isn't playing out the way we expect it to? So we'll take a look at that. And regardless of if we're right or wrong, where are we seeing opportunity now? Where are we looking for opportunity in the future? So that's the agenda. Let's get going with it. Long-term look at the 10-year T-note yield. Lots of focus on what's happening right now, and yields keep moving higher. They're new highs today. But it really started back pre-COVID that you started to make that that first original higher high after a decade of, multiple decades of lower highs all along the way. You started to make a higher high. Now that's continued now as we moved higher this year. So there's been a long-term shift in the trend in the T-note yield. Another way to look at that, again, we have the T-note yield and that trend indicator on the top. On the bottom, it's a percentage of time over the past 5 years that the trend has been rising. And if you got into the market at any point since the late 80s, you're not used to seeing this persistence of level of yields rising, of the trend moving higher. 62% is the highest since the early 80s. If you just look at on consecutive weeks in a row that the yield has been rising, we're at 140 some weeks now. That's the longest period since the 60s. So this is a new yield environment. Investors aren't catching up to that just yet. It's still how long will yields stay high, and then how quickly will they get low, turn lower again? I think that's the wrong question. It's more the persistence of the rise. How high could they get? And they're not likely to get as low as people have been accustomed to them getting in the past. And it's not just treasury yields, corporate bond yields also moving higher. Corporate bond yields are important because they're not just a market benchmark. It's not just the rate at which the government needs to borrow to finance its debt and its deficits. Corporate bond yields tie directly into the stock market. Corporate bond yields are what the price that corporations are buying. And historically, when corporations are seeing an increase in borrowing costs, so when yields are higher than they were 26 weeks ago, the S&P 500 doesn't just not go anywhere. It actually trends a bit lower. All the gains we're showing here since 2000, but you could go back into the 60s. All the gains for the S&P 500 come when bond yields are lower than they were 26 weeks ago. Right now, corporate bond yields are moving higher. This changes, then we can adjust and we can adapt. But right now, from a liquidity perspective, this is a headwind for stocks. Central bank policy, also a headwind for stocks. And what is interesting about central bank policy is it's not just the Fed. That's what we're looking at here, a series of rate hikes over the past year plus from the Fed. But if you look at when the Fed took off this time versus where it took off previous instances, in the past, it was leading the pack. It was leading the way to higher rates. This time around, it was emerging market countries that started the rate tightening cycle. The Fed, by the time it was raising rates, half of the countries around the world had already started to raise rates. So the Fed was late to this cycle. My theory on that is emerging markets know how to deal with inflation. They've seen it crop up in their markets time and time again in recent history. And so they saw inflation this time and said, yep, we got to do something to fight it, versus the Fed and ECB. And no, inflation isn't going to be a problem. It's going to be transitory. And they waited and waited and waited, and then had to act belatedly. So why does this matter? Because when most central banks are raising rates, the S&P 500 does not move higher. So it's not just a question of is the Fed done tightening? It really, and the other central banks done tightening. It's really how quickly and when are they going to pivot from tightening to easing? And until you have a majority of global central banks whose last move was to cut rates, this indicator suggests stocks have a headwind. Zoom in a little bit. First we'll look at Federal Reserve assets. They talk about not only are they raising rates, but they're drawing down their balance sheet. Yeah, a little bit, but let's not kid ourselves. It's still, twice what it was prior to COVID, four times where it was at the end of the financial crisis, eight times greater than it was before anyone was concerned about Lehman blowing up. So there's still, you have this bloated balance sheet on the part of the Fed. I'm not arguing that it needs to get back down to those really low levels, but it is still at an elevated level. And this unwind is likely to persist for a while, adding to the liquidity headwinds for the stock market. This latest blip, that's just because we're moving 6 months past the Silicon Valley Bank blow up earlier this year. And so there was a little jog higher in the balance sheet there. And then it's since moved lower. So looking at what the Fed is doing and what the market thinks the Fed will continue to do, this year has really been about the Fed persisting and the bond market pivoting. We saw that multiple times in reaction to various news events that you had the bond market convinced that the Fed was done, only to have to pivot back and acknowledge that the Fed was going to persist with rate hikes. What's happening now? This is a couple days old, so actually 2-year yields are moving into new highs, catching up to this view that the Fed is going to keep rates higher for longer than the bond market was anticipating. How high? How long? Well, these are the dot plots from the Fed. On the left here is what they were talking about in June. Talked about around between 5.75 as being the terminal rate for the end of this year, but then dropping significantly about 100 basis points over the course of next year. That was the expectation. That's kind of what the Fed had guided the market to as of June. Fast forward to this week's FOMC meeting and the updated economic projections that came out of that. They still expect the terminal rate this year to be in between that 5.5, 5.75 level, but expectations for next year are now above 5% is the median. So that's about 50 basis points higher than where they had been talking about in June. So yeah, the Fed didn't raise rates now, but it also suggested to the market that rates were going to be 50 basis points higher a year from now than the market had been expecting. I think the market is now catching up to this reality that higher for longer, and even when the Fed does start to ease, and if they back off a little bit, it's not going to be this aggressive easing cycle. It's just going to be a little bit backing off. But even there, time will tell. We'll have to see when they can begin easing. Right now, the Fed's still talking about another rate hike at one of the last two meetings this year. From an equity market perspective, the stocks are kind of behaving like the pattern has changed. It's been a while for investors in terms of seeing new all-time highs. If you got in the market in the past decade, you've never gone this long without seeing new all-time highs for the S&P 500. 427 days that was as coming into this week. As of the end of this week, we'll be tied for, I think, 1, 2, 3, 4, 5, 6, 7, 8th on the list of longest time period since the most recent all-time high. So this is a new environment relative to the past decade. It's not a historically new environment. We went 1,800 days in the early 2000s without a new all-time high. In the 70s, we went almost 1,900 trading days without a new all-time high. Keep these periods in focus. We'll come back to those later. So early 2000 to 2010, 1968, 69, and then into most of the 70s. That's, I think, very relevant for what we're seeing right now. From a breadth perspective, percentage of time over the past year where we've had more stocks making new highs and new lows, it's recovered after an absolutely abysmal year last year, record-setting year last year, but 35%, that's we're not even back to like anything except the what we saw during the financial crisis. No other period in the past 20 plus years was even this bad. And this is coming off the lows, but it's also starting to turn lower again. We're starting to see, again, more new lows and new highs. That improvement that we saw proved to be short-lived. And now we're back on the south side of the ledger in terms of new highs versus new lows. Volatility and weakness, again, improved over last year, but it hasn't gotten back to normal. 92% of the days last year had more days with had more stocks making new lows and new highs. That's dropped to 52% this year. So from 90+% to only half of the time, but still that's a little more than twice, or a little less than twice the median going back to the 1970s. It's more volatility than we typically see as well. Not as bad as last year, but still beyond the median. So yeah, it's been an improvement this year versus last year, but don't mistake that improvement for actual strength. And persistent strength is in fact fading from a trend perspective. Here we're looking at the percentage of time over the past decade that the trend for the S&P 500 has been rising. At its peak in early 2022, it was 85%. 85% of the time over the past decade, the trend for the S&P 500 was rising, meaning 85% of the time it was going up, only 15% of the time was it going down. A generation of investors got accustomed to stocks go up and to the right, pullbacks are brief, they're short, they're limited, and then stocks start moving higher again. That was the best, that 85%, the best reading of any 10-year period in the history of the data here, going back into the 60s. So it's not, I want to reinforce this idea that the strength and the persistence of strength that we saw over the past decade, that was the aberration. That wasn't the normal environment. Yes, it's true that you look at stocks do go up and to the right over time if you stretch to a long enough time period, but the persistence of the rise without any sort of consolidation, without any sort of lengthy pullbacks, was outside of the bounds of normal experience, setting records in terms of persistence of strength. So I think that makes the most recent decade not a very good comparison for what might lie ahead in the coming decade. Here's another way of looking at this. Is just on a 5-year basis, same sort of thing. It's rolled over and is starting to move lower. How low can it get? Late 70s, mid 2000s, we had periods where the S&P 500 trend was rising, less than 40% of the time. So, and we're still at 62%. So there's a possibility for more sideways, more chop, more pain for investors who are looking for up and to the right all the time. And what are investors doing about it? I think the better question is, what aren't investors doing about it? They're not moving away from stocks. This is the AAII Asset Allocation Survey as of August. Exposure to equities has stayed above average and is expanding. Bond exposure is about average. Cash exposure remains well below average. So there's not, from an asset allocation perspective, little evidence of accumulated cash on the sidelines, plenty of evidence of fully invested investors. Should actually go to this one next. So this is a relationship we've shown in the past between the AAII Asset Allocation Survey, that's orange now. The blue one is the University of Michigan Consumer Sentiment Index. Historically, there's a relationship between sentiment and positioning that has broken over the past couple of years. The degree to which it's broken is shown on this dot plot. Typically, more optimism leads to higher positioning, less optimism, lower positioning. What we saw over the last couple of years was less optimism, more pessimism, but not much of a change from a positioning perspective. It looked briefly like July was going to break that mold, but August now is moving back into that circle that has kind of circumscribed all the observations since early 2022. So we're back in that environment where we have a disconnect between positioning and sentiment. And when there's a disconnect, we go with the message of positioning, not with the message of sentiment. Sentiment is useful when it tells us something about positioning. If it's not telling us something about positioning, it's just an opinion. It's just how people feel. They're in bad moods for sure. Have they done anything about it? It doesn't look like it in this case. And so this, I think, is the thing we really want to pay attention to. I talked about paying attention to those peaks in the early 2000s, and then the decade that followed, or late 60s, the decade that followed. Those are periods where it's not just that stocks went sideways and you were better just waiting it out, you actually had better opportunities elsewhere. Data from Ibbotson, the Ibbotson yearbook, the decade following the 1969 peak that we're showing here, coinciding with this peak in household equity exposure. In the decade that followed, the S&P 500 returned 3.2% annualized, T-bills 5.9% annualized in this decade. The decade following the Q1 2000 peak in the S&P 500, the S&P was actually down 0.9% annualized. T-bills up 2.8% annualized. So there were better places to be. This, again, not an argument with, from a really long-term perspective, stocks go higher over time, but it's a challenge and an elaboration to that, saying, except when they don't. And some of the times when they don't, that's for lengthy periods. And what precedes those lengthy periods that we've seen in the past? Elevated household equity exposure, similar to what we've got right now. It looks very similar to me from an equity exposure perspective to what we saw in the early 2000s and what we saw in the late 60s, which tells me we need to be prepared for a decade of sideways, a decade of noise in terms of overall equity market activity and not much upside progress. Why do we think that? Why do I think that? Well, there's an inverse correlation between how much exposure households have, stocks versus bonds, and the forward returns to the stock market following that. So the blue line here is that household equity or household asset allocation, stocks versus bonds. And then the orange line, and this is inverted, it's on the right axis here, it's inverted, it's the 10-year forward price return for the S&P 500. So over the past decade, we've had a tremendous return because a decade ago, stocks were under-owned. That's the opposite of what we have right now. Right now, we've got stocks that are historically over-owned from an asset allocation perspective. So again, expecting the same performance or even similar performance from the S&P 500 to what we saw over the past decade in the coming decade, I don't think is consistent with the experience and the data that is out there. Stocks are expensive. They're not just over-owned, they're expensive. Not the most expensive they've ever been, but still above their long-term average. This is in terms of forward PE ratios. And it's not just on an absolute basis, but on a relative basis. And this might be the larger point. We used to talk about equity risk premiums. You'd have a higher yield for equities than you would have for bonds. That was the premium, the risk premium there. That's not the case right now. In fact, a month ago, you had higher, you had the 1-year yield on the treasury yield was actually higher than the S&P forward earnings yield. So you actually had a bond risk premium, which is something we haven't seen in over 2 decades. So on a relative basis, bonds are cheap, stocks are expensive. On an absolute basis, stocks are definitely expensive. It's a little bit murkier about where on an absolute basis bond valuations land, but they're certainly cheaper on a relative basis to stocks. So from an inflation perspective, lots of focus over the past year on what the headline inflation has done, what core inflation has done. I think we're really missing the boat by not talking more about median inflation. I think the Fed would be on firmer inflationary ground if it was focused on what was happening from a median inflation perspective. I don't think it will, because it's hard to explain median inflation versus just saying core inflation. You take energy out, you take food out. That's pretty straightforward. People can understand that. But the problem is median inflation does a better job of showing the underlying trend in inflation than either headline or core inflation does. In fact, the median CPI does a better job of anticipating the underlying trend in core PCE inflation than core PCE inflation does on its own. So we need to pay attention to that. It's coming down, but remember, it was at its highest level in over a decade prior to COVID. We'll get back to that in just a moment. This is a zoomed in look at what's happening with just the median CPI on a 12-month basis, a 3-month basis, coming down, but it's still quite a bit higher than where the Fed wants it to be. So I think it's premature to think about victory laps or saying that's enough. there's plenty of inflationary force still in the economy. You just open the Wall Street Journal and look at some of the wage debates that are going on in terms of how high and how much of raises various sectors are looking for. It suggests that we're starting to get this idea of more inflation, more persistent inflation needing to be reflected in union contracts and wages. That's the type of thing that starts to embed into the economy. That's what the Fed is really trying to avoid right now. Powell desperately wants to avoid being remembered as a second coming of Fed Chair Burns, who in the late 70s, just before Volcker, I believe, it looked like inflation was beaten, got easy too quickly, and then inflation took off again. And took Volcker coming in and really fighting inflation on a persistent long-term basis for that really to win that fight. You probably just saw the cat leave. The cat also, like Mowgli, is suffering from the needing to be around the humans when they're at home, because all of a sudden they're not as home quite as much. But anyway, back to the slides. This is a PCE X food and energy coming down. This is quarterly data, but still the latest quarter around 4%. That's twice what the Fed wants it to be. So still lots of work that needs to be done from an inflation perspective. This, I think, is the second most important chart. So that long-term look at the S&P 500 and that household allocation, I think that's the most important chart here. I think this is the second most important chart because it does a good job, I think, of explaining how we got into the current inflation mess that we're in. Go back pre-COVID. It's hard to remember pre-COVID times, but go back there. The Fed was starting to cut rates in late 2019 at a time at which, like I said, median CPI was hitting a 10-year high. The Fed got distracted. It was looking at headline numbers. It was looking at the trade war with China. It succumbed to political pressures from the incumbent at the time. It looked past the growing imbalance between job openings and unemployed workers, which is now its focus. I can remember going around Wisconsin in the summer of 2019 and talking to small business owners, and they already discussing this imbalance of well, I need to get more workers. I can't find enough workers, but I don't want to poach those workers and pay them more, because then my current workers are going to want to raise, or that opens up this bidding war among the various small and mid-sized manufacturers around the state, where it becomes a wage cycle or wage spiral because they're looking for more workers. So I think the seeds for inflation were sown right here when we already had that labor imbalance. We had inflation heating up and the Fed cut rates. And then everything that happened after COVID, that was just fuel that added to the inflationary pressures. Some of that fuel is this surge in money supply, 26% year-over-year growth at its peak. It's come down, but it's going to take a while to get that genie back in the bottle, if that's even possible. I mean, money supply always goes up. It has never gone up like it did in the period during COVID, and really, and then since then. It's cooled down now, but it's still quite elevated. You still have fiscal policy that is adding to some of that inflationary pressure as we continue to have these exorbitant deficits at a time where the economy is growing theoretically. And so it's just adding to that pressure. So we haven't really fought the fire yet. It's just, I think it's still some work to be done. And the longer it persists, the longer it's likely to persist. From a growth perspective, nominal growth is accelerating, real growth, not so much. That's the effect of inflation in the GDP data. Turning to the economy, we can see on a nominal basis, it looks like things are great. Average weekly earnings up 20% since COVID started. Over the past couple of years, real nominal retail sales up 13%, up and to the right, hitting new highs. You adjust that for inflation and the growth disappears. Super important point here. Growth disappears when you take away the inflationary impact. We're not used to thinking about the difference between nominal growth and real growth because inflation has been low and stable for so long. But here, real retail sales haven't gone anywhere in 2 years. Real average weekly earnings, so like think about the weekly paycheck, no more purchasing power now than prior to COVID. Just another look at the difference between nominal and real average weekly earnings. Nominal basis keeps going up and to the right. Real basis has flatlined. Same thing with retail sales. Nominal basis, the cash register receipts keep bringing up new highs. What you're buying is not expanding. It's just the cash, the receipt has a higher number on it. Your bag has the same number of goods in it. And it's not just there. There's other evidence of real economic activity stalling out. Real business sales, so that's retail plus wholesale. That's one of the components that the NBER looks at to determine recessions. That's rolled over. Industrial production is flat. U.S. truck tonnage has flatlined. Not seeing that expansion in real activity that we would expect to see if we had this robust economic environment that seems like we have if we look at the nominal data. Adjust it to real data, and growth is much less robust than it appears. Profit margins also rolling over. So how do we know whether or not this longer term view is likely to be a reality? What to do about it from a cyclical perspective or a tactical perspective? We've talked a lot in the past about weighing the evidence, staying on this balance between opportunity and risk. On the opportunity side, trends for the S&P 500, for the other large cap indexes, relatively okay. Breadth is not so great. It's down to neutral. Risks are liquidity. We talk about the impact of rising rates and the Fed. Valuations, you could add positioning in there as well. Economic fundamentals are mixed. Nominal growth, fine. Real growth, not so robust. And sentiment, we'll look at that. That could be one of the keys going forward. Right now, as we came into the month of September, balanced still towards risk, away from opportunity from a weight of the evidence perspective. This earnings revision trend, short-term indicator, but I think it bears paying attention to. It started to roll over. We're starting to see fewer stocks get those upward earnings revisions. And that started to accelerate now, accelerate downward in the last couple of days. This chart's a couple days old. If that intensifies, then that opens the door for more volatility as we go into the fall. If you look at the pattern over the past year, it's been higher highs and higher lows in the earnings revision trend. That's been a support for the S&P 500. If the S&P 500 loses that support, I think some of the breadth issues, some of the complacency issues really start to move more towards the forefront. From a sentiment perspective, we all often talk about, are people more bullish than they were last week or less bullish than they were last week, and immediately want to jump to some sort of contrarian take on that. I don't think that's the right way to think about sentiment. I think we want to think about longer term moves from excessive pessimism to optimism, and then optimism to pessimism. And remember that it takes bulls to have a bull market. All the net gains over the past decade or so have come after optimism has expanded. When investors are engaged with the market, are looking for stocks to go higher. You can get to extremes, yeah, but really you want to see that expansion in optimism, elevated optimism persisting. So far, we're seeing that in terms of investors' intelligence data. The AAI data that we got this week, we're back to more bears than bulls. That's not a good development. So if as we go into the fall, we lose the optimism that was built up earlier this year, that I think becomes a headwind for stocks. The emergence of pessimism is a headwind. When we get to excessive pessimism, yeah, that tends to be a good buying opportunity. We remember those extremes, but the movement towards those extremes tends to be a painful process. Bull market behavior, we've talked about this in the past. This remains the case where from a price perspective, from a trend perspective, trends are rising. The long-term trend for the ACWI is rising. The value line geometric index, it keeps going back and forth across 550, but there's a slight upward bias from a long-term trend perspective. The S&P 500's 200-day average continues to rise. Those are all bullish for stocks. The things that aren't so bullish are the breadth indicators, the percentage of global markets above their 50-day average, the fact that we continue now to have more new lows than new highs on a weekly basis, on a daily basis. Those are not the type of environment where the S&P tends to rack up gains and keep those gains. So this is a look at rising 200-day average for the S&P 500. When it's rising, the S&P does well. When it's falling, the S&P doesn't do well. Right now, this is rising from a trend perspective. If you're just looking at that, things look okay. From a tape perspective, things don't look okay. Green line here, that's our net new high trend line. Typically, this moves with the S&P 500. Right now, it's moving lower, even though the S&P 500 has been a bit more resilient. If this can't turn higher, then I expect this will turn lower. And as we continue to see more new lows and new highs, that puts more and more pressure on the S&P 500. Our fear of strength model is certainly arguing for caution right now. We have neither strength nor fear present in the market. So we don't have an elevated VIX. It's off of its lows, but it's not elevated at this point. And we don't have strength. We don't have more new highs than new lows. And when that's happened in the past, going back to 1990, when the model's been negative, the S&P 500's been down at about a 6% annualized rate. When the model's been positive, either fear or strength has been up at about a 12% annualized rate. So over time, the model is positive about 70%, 77% of the time, negative about 0.25% of the time. That's about right in terms of thinking about how often the market rises and falls. Some would say, okay, well, it rises 75% of the time. What are you going to do about that? I say, listen to fear or strength. If we don't have either, we're probably in an environment where the S&P is going to fall. That's what the data suggests. The data suggests is not so random as, well, you can't tell, so you can't do anything about it. And this isn't just historic data. Go back over the past 2 years, this model has continued to work. Since the end of July, August 2021, the S&P 500 basically flat. When the fear of strength model has been negative, the S&P is down about 20%. When the fear of strength model has been positive, the S&P has been up about 20%. So it's still working. It's still giving us a useful signal about what's happening in the market. If there's fear, if there's strength, then you lean into the opportunity. If there's neither, risks probably outweigh opportunity. And then we end with, in terms of the market, before we get to the what to do about it, with the question of can the S&P itself hold up if we continue to get more new lows and new highs? And so far, the answer looks like no. We've now pushed below 4,400, and we're seeing net new highs or net new lows expand lower. Today, we're pushing lower both on the S&P 500 and we're seeing an expansion in the number of stocks making new lows. It's the most, I believe, since early May that we're seeing today. So what to do about all this? Well, we can think about long-term trends, the trends that were persistent over the past decade, things like tech over energy. Those look like they have run their course. We saw 2 years of energy outperformance relative to tech. Tech has tried to seize the upper hand this year. I don't think it persists at this point. Keep an eye on this ratio. I expect that this move in favor of energy and away from tech is just beginning, probably hasn't fully completed just yet. The US versus the rest of the world. We went through, again, a decade of US outperformance relative to the rest of the world. That followed a decade where the rest of the world did a lot better than the US. Over the past decade, diversification has done exactly the opposite of what it's supposed to do. Global diversification, we're taught in textbooks. That's what I'll be teaching in a textbook to the college students. Global diversification improves returns, lowers risk. What has it done over the past decade? It's lowered returns, increased risk. Anytime you've diversified away from the US, I think that is changing. We've started to see hints of it. Right now, the US is again in the trend is favoring the US, but expecting to see these protracted runs of US leadership like we saw over the last decade. I don't think that's in store as we go forward, as we look forward to the next decade. And then diversifying just away from stocks generally, I think might be the best long-term play. To think about that, to have commodities part of the conversation. Too often, commodities underperform for a year or two and they get dropped from the conversation. And so you can't even consider whether or not they're improving relative to stocks. Keep an eye on the ratio between the S&P 500 and the CRB. Right now, it favors the S&P 500. But again, this comes after the longest period of commodity outperformance relative to stocks since the 70s. I don't think we immediately go back into this. It's all stocks all the time type environment. Keep your asset allocation options open. Why does this matter? It's not to try to juice returns. It helps in that regard to some degree, but it's more a risk mitigation strategy. You bring your standard deviation of returns lower by moving into commodities when commodities are favored relative to stocks. It's again, it's not a speculative move. It's a risk mitigation, risk management move to include commodities as part of the conversation. So we think a lot about stocks versus bonds. The 60-40 portfolio, I think going forward, it's got to be stocks and bonds and bills and also commodities. Our systematic asset allocation model is moving back into commodities. Commodities trend on an absolute basis, turning higher. We've had some of those periods over the past decade. It looks like we've got another one forming right now. This is our Blue Heron model. This is a week or so old, but again, it gives the message of you don't need to just sit still. You can lean into whether it's within stocks, within bonds, or from a systematic asset allocation perspective, lean into the areas that are working. Listen to the message of the market, adapt to what you're seeing. And so where does that leave us from a summary perspective? For many new investors, this is a new environment. For many investors, this is a new environment. It's something they haven't experienced before. Many investors are like Mowgli. They're used to the people being home all day long. Now that has changed. It seems foreign. It seems like a historical aberration, but it is actually a return to a more normal pattern of behavior. A new environment brings new opportunities. This is not a case where there's nothing to do because there's no opportunities. There are always opportunities in the market. Leaning into the things that are trending higher, reducing risk as appropriate, I think are things that we can focus about. If it's not up and to the right, the opportunity cost of being out of the market is not nearly as high. So increasing some cash on the sidelines, looking at other assets, I think makes sense in this environment. It's a lost decade for equities, does not need to be a lost decade for investors. Those that can adapt to the new reality don't need to just sit and ride the roller coaster of volatility. Ultimately, successful navigation requires listening to the market. Too often we think about investing in the market as a motorboat ride. You get your heading, you set your throttle, you hold on, and you'll eventually get to your destination. That I think in the back of many people's minds is what investing is like. In reality, the investing experience is not a motorboat ride, it's a sailboat ride. Sometimes the wind's at your back. Sometimes the seas are choppy. You can't just trust pointing the boat in one direction and staying there. You tack, you come about, you have to adjust your heading depending on the conditions. Sometimes you make a lot of ground up. Sometimes you sit dead in the water for a little bit. That's the reality of investing. It's what you're doing in the environment with the conditions that you have. It's not independent of the conditions that you have. So that's the long-term. From an intermediate term perspective, the weight of the evidence says more risk than opportunity for stocks. From a short-term perspective, the absence of both fear and strength suggests this continues to be a market, an environment where stocks are likely to struggle until we see one or the other emerge. At this point, it likely begins with fear emerging. So looking for the VIX to soar above 20.5 at some point, and then seeing if that fear can bring in a burst to buy and start to accumulate more new highs and new lows. Until then, it's a high risk environment, especially given what we're seeing in terms of bond yields continuing to rise and those macro headwinds being out there. So that's the reprise of the talk that I gave to Sheboygan Economic Club earlier this week. Hope you enjoyed it. Thanks for listening. And I'll talk to you all again soon. If you got questions, I'll just throw this last one up here. Got questions, feel free to reach out. Willie Delwich, High Mount Research. There's various ways you can get a hold of me. Email me on Twitter. Also visit us, highmountresearch.com or highmountresearch.substack.com as well. So I'll talk to you soon. Have a good one.